Hello, 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 everyone. Thank you so much for being here today. We are so excited to have David Barrett here. He is an expert in the field of cost segregation. He's been doing this for quite a number of years to improve his clients' cash flow for many years. And he is going to tell you all there is to know, which I don't know if that's ever possible today, about cost segregation and how you can use it for your tax advantages and for your clients' tax advantages. So thank you, David, very much for being here. Please take it away.
Okay, thank you. Thank you. Let's share the screen. I got a couple slides I'm going to go through. How much time? 20 minutes, I think, at
Yeah,
the moment.
15 or 20. Yeah. And then we go to
Okay.
Q&A.
Okay. We're going to go through this fairly quickly. You should be able to see this. This is just a house that we recently studied. And let's see. That should be easier to see now that I go to the house. You can see that, right?
Yes.
Okay, great. So I'm going to give you kind of a broad view of cost segregation, and basically there's a choice. You can either do straight line method of depreciation, or you can do the cost segregation method. The straight line method, if it's a monthly rental, you just divide the entire cost of the property by 27 and a half years, and you take that as a deduction. Or if it was a commercial building, 39 years. But pieces and parts of the building can be depreciated faster. In fact, there's a 5-year and a 15-year property class. And there's also a 7-year, which we'll talk about, which is in this property. But as we walk this property, this is everything outside the property is called 15-year property. That would be the driveway, the lawn, the landscaping, things like that. The fencing is 15-year property. This driveway, the value of it is considered 15-year property. The awning, the railway, you get the idea. I really like this property. Jen Maldonado that bought it because it's got a huge backyard. They bought it in Long Beach. They're looking to turn this into it's got great opportunity for ADU or for a multi unit property. So that's why they bought it. Something that's interesting to know: if you buy a property and you intend to tear it down and rebuild something else, the whole value of that structure is going to become land, which has no depreciation value. So if you're going to do a tear down, you want to do it, you want to put the property in service and then do a cost seg study before the teardown, because you're going to capture tax savings where there's no recapture. There's no recapture in this situation. Interior, all the 5-year property, that vinyl flooring has value. All the molding around the doors, these window treatments have value. Cabinets in the kitchen are always a big write-off. Hardwood flooring throughout this property. Again, the beautiful cabinet in the bathroom has value. And the older homes have all of these build outs and all the wood and all the time it takes. And even these doors have special panel sections. These have extra value actually from a cost seg perspective. And again, all of the molding around, but you get the idea. So this is how that property, after taking out the land value, this is the house. And then I'll show you the shed in a minute. But the house was, the tax professional comes up with this number. They tell us what the land value is for that area. They give us the number of the entire structure and the shed. And then we break everything down by the 5-year, the 7-year, the 15-year, or the components that cannot be accelerated in this property. It looks like, quite a bit. But here's the 5-year property. You should be able to see the cabinets, the molding, the flooring, accent lighting. All of these things have value. There's one 7-year item there's another shed behind the the actual shed. There's another smaller shed, and that's what has $1,500 of value. But basically, here's the bottom line. Pretty much every property I've ever studied, about 20% of it, and you can see in this property, it's actually quite a bit more, but usually 20% of any property can be accelerated for depreciation. The last category here cannot be accelerated. That's a depreciation deduction that the property owner is going to take over the next 27 years. But the reason I wanted to do something different today, a lot of people know cost seg, but they don't know that, yes, we calculate the depreciable cost of every property, but we also provide with our studies the replacement cost of the major building systems. Why is that important? Well, for many, many years, the IRS never really clarified when you can expense and when you have to capitalize. And they finally did. And we're going to get into that today, which is a really, I think, kind of an exciting thing for people to know that are in real estate. Okay, I got to stop that share. Got to go to the next share very quickly. Where is it? It's this one. Okay. So let me tell you, so I'm going to show you how a cost seg study can help you expense more in the future. That's one of the things I definitely want to do with you today. But the other thing I want to do is mention an opportunity where you can do all 3 steps of a great tax opportunity of buying a new property. And the best way I can do it is with this sample study that I did. Got to make that bigger. Sorry, there we go. So there's 3 opportunities to do a cost seg study. This is a property in Malibu. He paid like 3 point something for it, and land values in Malibu is about 50%. So this is actually 1.8 million was the cost of what he bought. Once you take out the land, this is everything else. This is the driveway. There's 2 structures. There's 4 commercial units in the front, and then there's another building in the back that has monthly tenants. And then now he's doing a STR, I think, in one of them. But anyhow, here's always the opportunity that people have. They can take that 1.8 million and they can divide it by 39 years. This is mostly a commercial property. So you would divide that number by 39 years. And the first year, 2019, they bought it in the middle of the year, August, almost in the middle of the year. So they're only getting half of 2019 because straight line method of depreciation is prorated. So they got half of 2019, all of 20 and 21 when I ran this estimate. And without doing a cost seg study, the deduction would be 110,000. By doing a cost seg study, again, like I say, most of the time, 20%, 15% of the property qualifies. Our estimate was for $416,000 of depreciation to be applied with a cost seg study instead of 110 without the study. The difference is the reason they should do the study. $306,000 of faster deductions in a 40% tax basis. That's $122,000 of tax savings. Everybody knows about how to buy a building. The key is you got to put it in service in the tax year, which means you've got to collect rent in a tax year before you can actually apply any type of depreciation. So if you're looking to close on a property at the end of the year, try to get at least a week or 2 of rent built in. If hey, I want to close in 60 days, but they don't want to leave for 90, no problem. I want to close in December. If you're buying the property, you want to close in December, carry back rent. Then when you talk to your tax professional about doing depreciation deductions for the property that you're buying in tax year 23, if you can collect rent this year, you can apply this type of deduction. It will go against all of your active income, not just this property, actually, the way that the depreciation deductions work. Now, here's what's interesting, and this is what's exciting. A lot of people know everything I've told you so far, but they don't know these other 2 things. Now, if you're going to do a renovation, if you can send us a list of everything you're going to do, here's the cost of the cabinets, the flooring, the paint, everything you're going to do. If you send us that as a budgetary item, we can do an estimate of the acceleration of those depreciation items in the cost seg study. And in this item, he spent like 1.3 million on the property, and we estimated that there's probably $357,000 of that could be accelerated depreciations that would save him 140 grand. But I haven't told you what most people miss, and that's the 3rd step that's coming now. Interestingly enough, it makes sense. The IRS has the tax code written in a certain way that if you buy a property in one tax year and you immediately do the renovation, it's in the same calendar year you bought the property, they don't allow you to have the value of what goes in the dumpster to be another expense. What I'm about to train you, or quickly, not train you, there's not enough time, but I'm trying to plant in your head is the idea of a PAD, a partial asset disposition. So when he told us, here's what I'm going to do with the property, we came back with an estimate of his accelerated depreciation with the new components going in the property, but we also estimated what he was going to throw away. The IRS does not want you to have two roofs on your depreciation schedule. When one goes in the dumpster, if you have a cost seg company, we know exactly the value that you could expense that year because we already studied the roof and the value of it when you bought it. You follow me? But here's the key to the whole partial asset disposition. If you buy a property, and I get this, most people in real estate, they don't give any time. They're always in a hurry. I get back to you. I get back to you. I'm so in a hurry. They're in such a hurry to buy a property that they immediately go into a renovation. If they could simply get an estimate from us, if it's a really big renovation, it will give them optionality to consider, you know what, if I just collected some rent this year and I don't start doing any of the renovation till January 1st in another calendar tax year, then you can actually get the value of this 236,000 going in the dumpster. This 94 grand can be another expense. Now, you know what's interesting? Here's what's very interesting. If you don't take a PAD, a partial asset disposition, in the year you throw it in the dumpster, you can never go back and capture it. You lose it if you don't take it the tax year of your salvage, of your dumpster renovation year. Here's the rest of the story. I was pretty new, and luckily I was very respectful when following up with this particular prospect and his CPA, because this looks incredible. Why wouldn't anybody do this, right? But see, what we don't know is the entire person's tax situation, and I don't ask those questions. I don't think that's any of my business. My job's to run an accurate estimate, push, so I know, hey, if you do go ahead with it, these are going to be your results. And 95% of the time, we do better than our estimate. I can look you in the eye. We like to underpromise and overdeliver because we're paid half to get started and the other half is paid when we're done. We don't want anybody unhappy then. It's just a business. It just makes good business sense. But when we run an estimate like this, it's the truth is this guy had so many other write-offs from so much other real estate. He never did this study. He's yet to do the study. I'm going to follow up this year. But I was trying to be respectful with this tax professional. I'm saying, okay, you might not want to do the study, but you do realize you're going to miss this write-off if you don't take it this year. And that is tax law. So does that make sense? We'll come to questions later. Okay. Let's see. What else did I want to show you? Okay. So I'm going to bring up another document in a minute. But every one of our studies has what you paid for the main building systems and everything. And it also, we include, other companies don't, but CSSI includes the current replacement cost. Why do we do that?
Why?
Because I'm going to show you our summary of the repair regulations. Okay, back up for 1 second. CPAs are pretty conservative by nature. They're not going to want to create an audit if they don't have to. For years, anytime you spent a lot of money on your property, they would automatically capitalize it, which means you're going to deduct it over 27 or over 39 years. Not your best strategy to capitalize. Some things have to be capitalized, and I'll show you what those are in a second. But if you can actually, if the IRS would finally come out and explain what a repair versus capitalization is, that would have been a wonderful thing. Well, they finally did in 2014, I think, and I'm going to go through that document with you in a second. But what I'm here to tell you is in that document, it says the following. If you spend less than a third of any of these building systems in a calendar year, you can expense it.
Oh.
And that's exactly the response for many CPAs. They still haven't done this. They're not going to go back and change everything. So you, as a property owner, you need to know this yourself. And this, I took this from a 99-cent store that I studied just because I know the building systems would be large numbers here. Here's what I just want you to realize. The HVAC system on this 99-cent store is valued at nearly $232,000. The IRS finally came out and said, if you spend less than a third of that number, you can expense that 70 grand in the same tax year. Most CPAs, most tax professionals, they probably do know this. But how do they know? How would a CPA know to go on your roof, look at your HVAC, and know it's worth that value to be able to come up with a less than 30% number to expense? I hope that's giving you some food for thought. So if I could, I know I'm probably beyond my time, but if I could show one more quick document, I think you'll find it very important. How are we doing on time?
You're good.
Am I good? Okay, great. All right. So this is a document that I think it's really important, and I'd be happy to share it or send it to Peggy if she'd prefer to send it out. But this is something we send out to clients when we do a PAD, a partial asset disposition. It's just part of our studies because it's I need to make this. There it is. That's the button I need to push. Okay. And that's probably too small. But anyhow, okay, it was passed in 2014. So this has been tax law for nearly 10 years. But I can tell you it's just not being followed. And a lot of people that own income properties are paying too much in taxes. So I can send this document to you, but very quickly it says, if the expenditure meets the definition of any of these four categories, it must be capitalized. So if it's one of four things, it has to be capitalized. Restoration is a non-performing property that you put it into service, I think is what that is. Adaptation. I'll send you the whole document. You can read it. But here's the examples. For example, the cost of the expenditure on electrical. How many old homes need to have the electrical wiring redone? As an example, just as an example, right? Well, if the cost of the expenditure is less than 30 to 40% of the current replacement cost of the electrical system, then it most likely can be expensed. Are you getting this?
That's great.
Cool. Couple other quick examples, and you'll see they all say the same thing. As the unit of property for carpeting is the whole carpeting a building, at any time the taxpayer replaces or has a plan to replace more than 35% of the carpeting, it must be capitalized. However, any amount of the carpeting of less than 35% of the building's carpeting should be considered and deducted as a repair and maintenance expense. And the same here, they talk about cabinets, 35%. But this is just something that a lot of people just don't realize. And okay, let me go back, stop the share, go back to this will be my last thing I'll share with you, and then we can maybe do questions if you have any.
I do.
Yeah, so which one is this? HVAC dryer, ceiling system. Oh, that's the one. Okay. Yeah, so with every one of our that's the shed. Let me go back up to the house. It's hard for you to conceptualize this when the numbers are smaller on a house, but it still works. Let me give you the quick idea. If you had to replace a roof on this home, where's the roofing? Oh, there it is, roofing systems. The replacement cost is $6,700. It's not a very big house, but spending a third of that is a couple grand. You're not going to be able to get much done with that, actually, unfortunately. If this number, let's say this is a commercial building, and let's say the roofing system was 100 grand, and for 20 grand, you could just put a new membrane on. This report can substantiate that as an expense. If it was 100 grand here on the roofing, if you're spending less than a third on the membrane, it qualifies as an expense. But what I'm here to tell you is probably most tax professionals, because they don't know you have this study to rely on to make those expense versus capitalization decisions, because they don't know the replacement cost. It's just another way that our studies help property owners to reduce their taxes into the future. So hope that makes sense. Another quick story. If somebody had, let's say the parking lot replacement value was $75,000, and it was 3 different sections. And one was under trees and it wasn't cracked. It was in the shade most of the time, but 2 of the sunny ones. Well, if you could do 25,000 in December, 25,000 in January. That's 2 separate calendar years, and maybe put off the other one for a year that didn't need it. I mean, if you know what the replacement cost is of your major building systems and you're going to replace windows, it just can't be a betterment. You can't go from a single pane to a dual pane. It has to be, you can't go from regular shingles to solar shingles. It has to be a replacement. It cannot be a betterment. That's one of the Rabbi laws. Can't be yeah. Anyhow, I'm not a tax professional. I just know enough to help you save tax money. So there you go.
Okay. Great. Is that it?
That's it. That was the main stuff I wanted to cover. I've never covered the replacement cost and how that can help with future taxes. If you have a recording of this, it's something I would send out to my clients from time to time. Hey, you don't have time to hear me explain this, watch the video. Because real estate people are just so busy,
I know. I'm going to send it to all of our sponsors. And I just talked to somebody. I just got off the phone with somebody right before this who's buying he's buying a fourplex that's only 3. It's coded as a fourplex. So he's taking the garage and turning it into the 4th unit, which is already approved by the city. So he can do that. And it's coming to the close of the year. So what you're saying he could do would be the proper thing to do, because he's going to have trash, but probably not a whole lot of it.
Yeah.
Still.
Yeah. It's the best situation if you can buy a property and it's in service in a calendar year. So you're able to depreciate it you get that depreciation deduction against all your rental income. So if you can buy something by the end of the year, close on it, get rent this year so you can depreciate it. Give us a budget of what you're planning on doing. Hey, you've already got your 3 bids. This is what we're going to do. Here's the carpet guy. If we could just get a list of what you're planning on doing, we can run an estimate of the tax benefits of accelerating those depreciation items. But we will also be able to do a rough estimate of what's going in the dumpster, which he would qualify or she would qualify for, because he did put it in service in one tax year and didn't do the renovations till January 1st. That is the perfect way to do it, with the 3-step tax opportunities. And then there's another benefit too. If we can study the property, I mean, he can apply the deduction to 2023 if we can get the study quoted and get it done. It takes us 6 to 8 weeks to do all the calculations. It's a pretty thorough process. But if we could do the study of the building, let's say it's a commercial building and he knows he's got some AC issues. If we can just study the building, we'll give him his replacement cost. And then he would be able to decide how to expense it next year, right? Here's the thing. This is the most important thing, and it's easy to remember if you think about it logically. If you buy a building, but you don't get any income on it, and you replace all the AC and everything, there's no value to what goes in the dumpster, because it's the same year you bought it. So it has to be functional into the next calendar year. Then if you dispose of it, the IRS said, well, they're disposing of an item that they did use in a previous tax year, so we will allow it. And we will allow that to have value. It's a little confusing, but the beautiful thing is I've only been here going on 3 years, but CSSI is really great. The founder of our company was involved in the very first cost segregation. Supposedly he was in the room, and why are we writing off carpet in 39 years at this hospital? It was Columbia Hospitals. He was an engineer with Deloitte and Touche, I think. They brought him in. But anyhow, he was like, carpet lasts about 5. Why am I writing it off in 39? And it became tax law. But he's just a very brilliant, a little bit eccentric gentleman. But he has just a wonderful company. And everything they do, I must tell you, I would not change a thing that they do here. The estimates are run by analysts. They do all the work, so they can look at a property and pretty accurately estimate the tax benefit. They also estimate their time involved to do that small condo or 5-story building. So the pricing is always very accurate in terms of competitiveness, because the people doing the work actually do the pricing. Everything here is just really, really well done. I forgot what my main point was. I just went on a CSSI rampage, but
let me ask you a couple.
But if we could do an estimate of a property and they could see the replacement cost of those units, of the windows, the doors, the electrical, everything, they would then know better how to approach that entire renovation from an expense standpoint and get those write-offs next tax year instead of over 39 or 27 years. And our studies don't just help you with the depreciation. We take the time to do the replacement cost, which is what's required now. Anything less than a third of the replacement cost of a building system can be expensed. And it's just a huge thing. And nobody knows that that's inside of the studies, that they got in a hurry to save their taxes. They don't even know it's in there to help them in the future. So
Okay, so I have a couple questions.
Yeah.
One of them is, where do you get the list of what the replacement costs are on things? Because everything's a different square footage, different stories.
How does our company do the studies for the
No, I'm
replacement
asking, where do you get that information? Is
for
there
the replacement
is
cost?
there a software? What?
Well, if you're replacing something, what I'm told they do is they find something that would replace it. And then they go back the number of years it's probably been on that property to depreciate, to remove the inflation of it's a complicated thing.
So is this something you make up, or is this
Oh,
something
no, this is
IRS? There's an IRS.
Oh, the one thing I haven't mentioned is that our company's done this for 21 years, over 45,000 studies. We stand behind all our work with audit representation. There's no cost for us to satisfy questions of the IRS as long as it takes. Most of the time you slide the 30-page report to them, explains everything. But if they have any further questions, I've been told that they had personal questions that maybe 15 times in 21 years, we had to answer them on the phone with other questions. But it's in our paperwork that we will take. And there's not another company has a cap on 8 hours, but ours is unlimited because we know the study was done correctly according to all the engineering guidelines and technical construction cost information.
Okay, let me put it in a different way so that I could get an answer.
Mm-hmm.
Where does the replacement cost come from? Does the IRS have what the replacement costs are? Or
they will ask us how we came up with it, and we have a methodology that's never been refuted in 21 years.
So you make it up?
We do the numbers. We find the actual component when it was put in the property. We do a lot of math. The size of it, the age of it, the inflation rate since it was purchased. It's complicated.
Okay. I just thought maybe you might have a software program or something like that, or someone had a software program where the IRS said, this is what replacement costs are, which I wouldn't be surprised about because they know nothing about real estate. So okay, so
well, there are some do-it-yourself software programs, and at our national meeting, they asked, our CEO was talking about it, and he was saying, well, he thought I mean, there are software programs. I just helped a lady in Florida with a large property. She bought a software program, but she couldn't even do it because her property was over 400,000, and I guess there's some range that the software company can't even be used for, or whatever. So anyhow, a client of mine referred me to her, but our corporate office also says a couple things. Number one, that it's supposed to be an arm's length relationship of who studies your property. And if you're the one studying your own property, automatically it would probably be more auditable, he thought, just as a thought. And then the second thing, there is another company major to ours that's an engineering-based cost segregation company like ourselves. And in order to try to be competitive with us, they're not as big as us. There's 150 of me around the country that can do the quick visit and get the IRS requires the site photographs. But there's another company that has the client, the real estate owner, go take the pictures and the videos. And what's interesting is, according to our CEO in each of the audits, the first question they asked is who took the pictures. So that could be a problem too. So everything that CSSI does is exactly by the IRS guidelines, where we use the number one method they recommend. We do the pictures, we do the site visit ourselves. But there are some softwares that you maybe could do a smaller home, but it'd be better to have an independent third party do it. That's my only comment. So.
All right. And Clarence has got a question.
Mm-hmm.
Still muted. There you go. Clarence, you're still muted.
Hello, sorry. Thanks,
Sorry.
David.
Sure.
Hey, I think you mentioned that there was no recapture for cost segregation.
No,
Did you
no.
say that?
I said for expensing the stuff going in the dumpster, there's no recapture.
Okay, good. Now,
That's why you got to take it in that year, because if you
right.
don't take it in the year it goes in the dumpster, you never do. But yes, recapture.
There is
recapture. Go ahead. Sorry. Yep.
Yeah, so there is recapture on cost segregation. You're
Yep.
just saying that if you have like countertops, whatever, or let's take it to the extreme. Let's say I buy a house, I'm going to tear it down, build another house. If I put it into service in the year I buy it for a few months, then I tear that house down. Can I expense that house?
No, but you could do cost seg and accelerate 20% of it as a deduction before you tear it down.
And then expense that portion when I do tear it down?
I don't know if you can. That's a great question.
Okay.
I don't know. I just know you can accelerate the depreciation before you tear it down, and there's no recapture in that situation. Maybe
Okay.
that's what you're asking me about.
Okay.
Yeah.
Okay.
Yeah.
If I can ask you a couple of others here.
Mhm.
If let's say a person has a 10-unit building
Mm-hmm.
and they replace the cabinets in 1 unit,
Mm-hmm.
they can expense that, I think, because it's less than a third of the building, or does it go by the unit?
I believe you're correct, but I would never base any decision on what I have to say. I know like a little bit of this tax code, but my understanding is I can send you, or I'll send to Peggy, that it's like a 15-page document that goes into the repair regulations and what you can expense and what you can't. But yeah, if you're just doing a regular, somebody moved out and you're not doing a betterment, you're just trying to get it back to a rentable condition, right?
Mhm.
Then my understanding is a lot of the cost of that 1 out of 10 units could be expensed. Yes.
Okay, makes sense.
But you're right. Many tax professionals would capitalize it. And
Right.
and we don't want to give tax advice. We just want to do whatever the tax pro, asks us to do. So if there are improvements, we have them confirm the improvements, and then we can accelerate that depreciation. So
Okay, thank you.
So let me ask you on top of Clarence. So we're doing we call it a make ready, when we make ready an apartment built, unit.
sure.
Can I also do the trash on that at the same time? Or is it different?
If you bought it in the past, you can. So if you bought it 5 years ago,
Yep. Now I have a make ready.
yeah, and you're just about to do the improvements, yeah. I mean, now in a single unit out of a big apartment building, it may not make sense for us to help you with it. We say, like, if you're spending like 200,000, it usually makes sense for us to do just a study of your improvements. But if you're just doing 1 unit where it's 20, 30 grand, I hear 40 grand sometimes, you're going to get a budget of everything you're going to put in that unit. And it's pretty easy to know that all the carpeting is 5-year, all the cabinets are 5-year. I mean, your tax professional can accelerate that depreciation pretty easily, but without a study of the building, we're not going to be able to tell you what the replacement cost is that's going in the dumpster, right? So
Right.
I don't know if we could actually help you with that. What we help, the way we're really helping people, unfortunately, is in a situation where they just bought a building, they want that depreciation. We're just saying, put it in service in that tax year so you can get that deduction that tax year. Any renovation, if you can put it off till January 1st, we can do an estimate of those tax benefits of accelerated the new components going in the property, the new carpet for those deductions, and then the old stuff in the dumpster. Yeah, if you've had a property for a number of years, you would have to do over $200,000 of work to make it probably worthwhile to consider us. Yeah.
Okay, so we have, I don't know what you said, Clarence, but all the hands went up. So Cliff, then Ted.
So question. So with the sunsetting of the Tax Cuts and Jobs Act of 2017, and and the bonus depreciation being reduced from 100% to 80% this year, and then 60% next year, and then dropping 20% until it's finally gone. Is
Yep.
there any benefit in waiting and doing something into the next year, or really should we try and get everything in the current year as much as possible?
That's a great question. And in my position, it's very hard for me to advise you because I don't know your income expectations for this year, last year, next year, and all that. But at a 50,000 foot view, you can time your cost segregation. And that percentage, I'm sorry, Clarence, I'm sorry.
It was Cliff.
Or Cliff, sorry, Cliff. It's the year the property is put into service that actually triggers that percentage. So if you actually have a property that you've never studied, you've never got accelerated depreciation, you've never done a cost seg study, but if you happen to have put the property in service from, I think it's September 27th, I think it's October of 2017 through December 31st of 22. If you collected rent in that entire period, you can get 100% bonus on the depreciation.
Oh, that's really good to know. I did not realize that aspect.
You can go back and capture that. Now, the law says that if you put a property in service this year in 2023, you get 80%. And if you put it in service in it's in service. It's when you collect the rent. It's not so much when you buy it. It's when you start collecting rent that you can depreciate it. So, but yeah, he's correct. It does go from 100 to 80, 60, 40, 20, and then it's done. But 80% is a really good number. And actually, they're all good numbers. I mean, I didn't work for the company. Like I said, I started working with them 3 years ago. My friend's been here for a much longer time that kept telling me it's a great place to be. But it's just, people that actually represented this company 20 years ago, it's still better to take 20% of your, I mean, you buy a property, take out land value. In California and Ventura, where I do a lot of studies, land's about a third, So you buy a property, take out land value, whatever's left, usually 15, 20, maybe 25% of it, let's say 20% of it probably qualifies to be accelerated depreciation. But you can get 100% of it as a deduction if you put the property in service from 22 through October of 2017. And again, 80% for this year, 60%. But, 21 years ago, I mean, if you could take 27 years property and get 20% of it as 5 year, I mean, that's a tremendous tax benefit by itself.
So David, quick follow-up on that question. So if a property were acquired in 2022, and they actually did begin collecting rents, and they decided to wait before they did a cost segregation, how long can they wait and still go back and do a cost segregation?
Great question. In Southern California, because properties are so expensive, you could probably wait easily 5 years, to be honest with you.
Does it make what state it's in?
Yeah, because properties they're so expensive here. I mean,
But we have people all over the United States here.
Yeah.
This one's in South Carolina. I don't know if you would know off the top of your head.
How much was the property purchased for?
$710,000.
Oh yeah, they'd probably qualify. Yeah. Sometimes when the property is only 200,000 or 300,000, you've already taken some depreciation in 5 years of the 27 years. So there's less to accelerate, but yeah, 700,000, you could probably, in fact, if the property is over $1 million or several million, you could probably still consider cost seg 7 years out. Maybe there's no cost for us to run an estimate, but generally speaking, it's always better for you to cost seg it the year that you buy it, because you avoid the 3115 form. Basically, the first time your property goes on a depreciation schedule as straight line depreciation, it's now on your tax return as straight line depreciation, unless you do a 3115 form, which tells the IRS, I'm changing from the straight line. I'm going to put in all these better numbers because I have all the cabinet value and everything else. So. Thank
you.
Yeah.
Now, Ted, you have a question? I know Matt had a question too, Matt Murphy. Go ahead, Ted.
This really isn't a question. It's more of an endorsement for David, because I've known about CSSI for more years than I want to count at this point, I think. And they have a pretty good reputation. I've never had a chance to use them myself, but I've never heard anything bad about them over many years at this point.
Yeah.
The thing for everybody to consider is that virtually any doctor can prescribe aspirin for a headache. But if you don't want to know why you have a headache, you want to talk to a specialist to figure that out. CSSI in this field is the specialist. And so if you have an issue, for example, that Cliff brought up, the $700,000 building, talk to them. As David said, it doesn't cost anything to talk to them. They're not charging you for that. And so, get an estimate from a specialist, and then you know what to do.
Okay, that was
Thank
very
you.
nice
Thank
of
you,
you,
David.
Ted.
Thank
Very
you, Ted. I owe you $5, Ted. I'm just kidding.
So,
Thank-
Matt, you had your hand up earlier. Did your question get answered, or you still have a question before we go to David?
I just do have a quick question for David. So, David, how does the process work? Like, are you guys looking at deals that people are prospecting? If they have questions about, the tax, just general tax questions, are you guys available for that, or how does the process work?
Just reach out. We never know the level of interest or work that's involved with the question, but there's the info, like Peggy was saying, or the other gentleman. Yeah, the information's free, and I have some clients that I've done a handful of studies each year for, and if they need anything from me, obviously I'm going to jump. And I will run estimates on properties before they close them. But they do take me a half an hour to type up the square footage, take pictures of the property from Google Maps and all these other places, so that my team of analysts can provide a really accurate estimate of the tax benefit and the good pricing that my client deserves. So there's about 25 minutes, half an hour of typing. So I don't want to do it all the time for everybody that's, looking at buying a property. But I'm telling you, if you know the land value in that area, just take out the land value. I'm telling you, if you want to know how much. Now the parking lot's going to be the big outlier. If it's got a big parking lot or a little parking lot, that'll throw the numbers really big maybe for that. But you could probably say 15 or 20% of pretty much any property you buy is going to have that much in qualifying components for bonus depreciation. And then, yes, you get 80% this year. You only get 60% next year. Just depends on when you close on the property. But if you kind of know those numbers, you kind of know what your tax benefit is with this. And I do think commercial realtors that are including a cost seg study on the properties that they have, that they're listing, so they can tell everybody, hey, this income property, by the way, I've already got an estimate on it. Here's what it would run. I think they're crazy if they don't get us to run those estimates. I think the smarter commercial brokers are having us do that with all their properties now. And that's just something we're happy to do because it is self-serving. We're going to get some business out of it. But more importantly, that commercial realtor is going to make way more money than us selling a building than a study. So
that's smart. Thank you, Matt. Mr. Andrade.
Hello, Peggy. I've been away for a few weeks. Now I'm back. It's good to see you.
Good to see you too.
I had a question for David. I was late, so maybe you answered this question. You mentioned as far as capturing the cost seg depreciation on the property, it has to be the same year. And then you said once it goes into rental status, is there a time frame of that? Because we're going towards the end of the year right now. I just have a property that I just rehabbed, so I'm just curious on that. Was it 1 month, 2 months? The first day. I'm just curious on that.
I think I understand what you're asking me. Basically, as soon as you put a property in service, that's generally the best time to get an estimate of what the tax benefits look like. If you're collecting rent in 23 right now, you could do cost segregation on that property and get that deduction, and it would go against all your rental income, not just the property that we study. So that tends to make it more appealing to people that have a number of properties, actually. Did that answer your question? I'm sorry.
And he already rehabbed it.
Already rehabbed it? Okay. Yep.
Yeah, I already rehabbed it. And as you mentioned, across the board of all your other rental properties, say if you have a dozen properties, and this is the only one that's gone through a full rehab. The other ones, have ACs and all this other stuff. I just gone through a bunch of those kind of things. So based on that, with the portfolio, how could that be, utilized in this way?
Yep. Most people that have a portfolio, as they get closer to the end of the year, they kind of know what their tax liability is for 23, right? So I will tell you the best. Are you a real estate professional?
Yes.
Okay. So all of these passive deductions offset your active income, which is a really bigger blessing than most people that own, that have tenants, and that's all they're not in real estate. But yeah, so what a lot of people will do that have a lot of properties, they get close to the end of the year, they're considering maybe either buying another property or cost segging one that they already have. The properties that you already have that would provide the biggest write-off would be the ones that you spent the most money on most recently. So if you look at, you bought 10 properties in 10 years, the most expensive one was maybe 2 or 3 years ago. I would maybe run an estimate on that one. And if you did, and I think Peggy was saying you did not do a lot of renovations yet, but you're considering doing some renovation. Yeah, I would not do any renovation if it's going to be a lot of money unless we run an estimate for you and explain it. Because here's the other thing, if we can do a study of one of your properties that you intend to do a lot of work on, and if you happen to spend a lot of money on that property that also needs a lot of work, if we study that property, there's going to be information in the replacement costs that will help you decide on some of that renovation to expense it instead of capitalize it. Your first thing you want to do is expense. Whatever's left, then capitalize if you have to. But you want that deduction over 27 or 39 years for sure if you can't get it expensed right away. So.
Okay. So I'm just trying to make this clear. You said over your portfolio, so you want to pick the one property that needs the most work out of your whole portfolio. Is that what we're talking about?
Well, that's where you can get the value of the study of the building to help you with your decisions on the work that you're going to do. It'll help you if you've got some repairs like some AC and some stuff like that. Then that's just another benefit of doing a study. But your best tax benefit is going to be the property that you spent the most money on. Take out the land value, whatever's left. That's the number that you're depreciating. The bigger that number, the bigger 20% of that number is going to be, where you could apply 80% of it against, or maybe 100% if the property's been inserted. If you have renters in there from 20, 21, or 22, you can apply 100% to your 2023 taxes because it was in service. It was first in service in those years. So.
I see. Okay. So, as you mentioned, so you take a lot of that out the first year. What about the next couple of years after that? It's just regular expenses, I would assume then, right?
Yeah. Well, basically, like I'm saying, it's about 20% of any property value that can be accelerated for these deductions. That means 80% of any building cannot be accelerated. It's going to still be a deduction for the next 27 years. You're just pulling forward part of it.
Oh, right. Okay.
Yeah. The tax laws are in your favor. I mean, in an inflationary environment, if we're losing 9 or 10% a year of the value of the dollar, I mean, those write-offs in 5 years are only worth half what they are now. I would take every write-off you could right now, save 50, 100 grand in taxes, and put that money in another asset, whether it's gold, silver, dividends, more real estate. I think we got an inflation problem. That's my thought.
Thank you.
I buy the groceries mostly. I made that switch with my second wife.
So somebody who's got a portfolio and they haven't done a cost seg, but they are getting ready to do some rehabbing, should they? So you're saying do everything now rather than take one a year?
Well, again, everybody's tax situation is different. And are they making a lot of money this year and they're not expecting as much next year? Or is it the other way around? You really want to, I think you want to take the deduction. You want to do cost seg and apply the study in a tax year where you have high income. If you can, that's always to your advantage. The best time to do it is the first year that you buy it,
right?
Because you're saving. We charge $750 to do the 3115 form. It's part of our study fee. Every tax professional I've talked to tells me they hate doing the form, and if they had to do it, it would run over $1,000. So there is, if you put straight line depreciation on your schedule, if you put it on there once, twice, 3 times, if you ever switch to cost seg method, there is that $750 fee. So if you missed it 1 year and you could do the study in 2 or 3 years, and you know you have high income coming in a year or two, there's no rush, right? Because you still get 100% bonus if it was put in service in 2018, 19, 20, 21, or 22. You still get to do that catch up, and it's a big deduction. It's a very big.
Right. Yeah. So the best thing to do is do it on the year you buy it.
Yeah.
And plan your rehabs around whatever y'all suggest to them for their taxes. And their CPA should understand this.
Yeah. One of the things, if I can mention one last thing, I know you're probably rounding up, but the one time you don't do cost seg, when should you not do cost seg? Well, if you're accelerating depreciation deductions and you're getting an interest-free loan from the IRS, that's basically what it is. I totally lost my train of thought. I'm so sorry. I'm trying to do it quick for you. I forgot what I was saying. I'm so sorry.
Maybe it'll come back to you because we're almost at the top of the hour.
And you don't do this. You don't do this if you're flipping the property in the next year or two, because all the tax benefits get reversed. The only time you do this, our company recommends you only do it if you're holding the property at least 3 more years, because everything we're putting a value on now, most of the benefits are 5-year property. If you keep it at least 3 more years, you can write down the value of that carpet a third after 3 years. So, or sell in a 1031 exchange in the next year or two, then it carries through. But if you think you're going to flip a property, then definitely don't do this, because you're just going to throw money away for the study and all the tax benefits. You don't have enough time with that interest-free loan to really do something with that money. So
sure, understood. Ted, your last question today.
It's also somewhat of an endorsement for David, but the idea is, if you talk to your CPA, and ask them about cost seg, and if CPA possibly may say, yes, I think it's a good idea, or he may say it's a bad idea. But what you don't want to hear from him is, what is it? In that case, find a smarter CPA.
that's so
Great.
fun. That's good. Touche, Ted.
All right, Ted, thank you very much for those endorsements. And thank you, everyone, for coming today. We're really happy you were here. Thank you, David, very much. We're going to send your information out with the email that we send to everybody. So it'll have your phone number and your company, etc.
We're happy to answer any questions. Thanks for the time, Peggy. Appreciate it.
Yep, we hope you come back again.